It's 9:30 in the morning on June 12th, 2026. In Times Square, New York, a bell is about to ring. When it does, a rocket company will be worth $1.75 trillion, more than Tesla. It is the largest IPO in the history of financial markets, 3 times the size of the previous record. And it is not alone. 11 days earlier, a company called Anthropic quietly filed paperwork to go public at $965 billion. 4 days ago, OpenAI did the same. 3 companies, $3.6 trillion, all heading for the public markets in the same window, all at once. Twice before in the last 26 years, the biggest, loudest stock market debuts have clustered together like this. Both times, what followed erased trillions, much of it belonging to ordinary people who arrived at exactly the wrong moment. So the question is worth asking slowly. Why is everyone heading for the exit at the same time? And what happens to the people walking in? To understand what happens next, you have to go back. It's January 30th, 2000. 88 million Americans are watching the Super Bowl. Between plays, an ad comes on. The star is a sock puppet interviewing strangers about pet food. The company behind it is called pets.Com. It loses money on almost every order it ships. 12 days later, it goes public on the NASDAQ. 9 months after that, it is gone, liquidated. 268 days from ringing the bell to turning off the lights. Pets.com wasn't an exception. It was the era. In 1999, more than 450 companies went public in a single year. A huge share of them internet startups with no profits. Investors weren't buying businesses, they were buying promises. And in the spring of 2000, the promises came due. Companies that had guaranteed explosive growth reported numbers that were merely ordinary. That was all it took. The NASDAQ fell 78%. And here is the arithmetic that ruins lives. The part almost nobody calculates in advance. Lose 50% and you need to gain 100% just to get back to zero. Lose 78% and you need 355. The fall took 2.5 years. The recovery took 15. An entire generation of investors spent the decade waiting to break even. Remember the mechanism. The bubble didn't pop because prices were high. Prices had been high for years. It popped the day expectations met reality. Now move forward 21 years, because it happens again, with one difference. It's November 2021, and you are an ordinary investor who has just discovered a company called Rivian. It makes electric trucks, beautiful ones. It has delivered fewer than 1,000 of them. Within days of its IPO, the market decides Rivian is worth more than Ford and General Motors combined, 2 companies that sell 10 million vehicles a year. This time, the promises were holding. Earnings weren't the problem. The problem came from somewhere else entirely. Inflation hit 9%, and the Federal Reserve raised interest rates from 0 to over 5, the fastest climb in 4 decades. Interest rates are gravity. When money is free, anything can fly. Any story, any promise, any sock puppet. When money costs 5%, only one thing keeps a company in the air: actual cash. Gravity returned, and the market split in 2. Meta, a machine printing tens of billions in profit, fell 77%, then climbed all the way back to new record highs. Rivian, a story, fell more than 80% and stayed there. That is the second mechanism. When gravity returns, stories die, machines survive. Which brings us back to June 2026 and the 3 companies at the door. Let's look at them the way a buyer should, with one simple tool. Take a company's price tag, divide it by 1 year of its revenue. A typical established business costs about 3 times its revenue. Hold on to that number. Anthropic, $965 billion on $47 billion of annualized revenue, 21 times. The most reasonable of the 3, and its growth is genuinely historic, from around 10 billion to 47 in about a year. The price simply assumes that never slows down. OpenAI, roughly $850 billion on $25 billion of revenue, 34 times, while burning through a projected $27 billion this year. For now, it is a machine that runs on borrowed altitude. And SpaceX, $1.75 trillion on about $20 billion of revenue, 88 times. Years ago, a famous tech CEO explained why even 10 times revenue is absurd. If he handed shareholders every single dollar the company earned, no salaries, no electricity, no taxes, paying back the purchase price would still take a decade. At SpaceX's price, that same impossible arrangement takes 88 years. To be clear, these are not sock puppets. Starlink has 9 million paying subscribers. The AI labs have tens of billions in real revenue. Nobody is asking whether these companies are real. The question is how much of the future you are being asked to pay for in advance. And then there's the detail that should make you pause. In a normal mega IPO, 5 to 10% of shares are set aside for ordinary investors. SpaceX set aside 30, $22 billion worth, triple the norm, something never seen at this scale. There are two ways to read that. The generous reading, letting regular people in early for once. The other reading requires remembering what an IPO actually is. For the people inside a private company, an IPO is the exit, and someone just made the exit 3 times wider. One more thing. Because you may believe none of this concerns you, you don't chase IPOs, you own a boring index fund, here is the uncomfortable part. About 15 trading days from now, SpaceX is expected to enter the NASDAQ 100. The moment it does, index funds around the world are required to buy it. Tens of billions of dollars of automatic purchases executed by formula. You will own this company. You will never have clicked buy. And the AI economy these companies sit inside is wired together like few industries in history. NVIDIA invests in the labs commit billions to cloud providers, the cloud providers buy NVIDIA's chips. Picture 3 friends at a table, passing the same $100 bill in a circle, each recording it as income. The money is real, but so are the wires. Microsoft alone owns roughly a quarter of OpenAI. If one node breaks, the current travels. So, the question in the title, will these IPOs crash the market? On their own, no. 3.6 trillion sounds apocalyptic, but it is roughly 5% of the American stock market. If all 3 lost half their value tomorrow, the system would absorb it. It has absorbed worse. But that was never the right question. IPOs don't cause crashes. IPOs move risk from insiders to the public. The crash, when it comes, still needs a trigger. In 2000, it was expectations meeting reality. In 2022, it was gravity. Those are the only 2 numbers worth watching now. AI earnings against expectations every single quarter, and interest rates. Everything else is noise. There is one trap left to understand, because it catches people even when everything goes right. Imagine a company earning $1 billion a year, priced at 100 times that. Next year, profits jump 40%, a flawless year. But the mood cools, and the market now pays only 50 times. The company is suddenly worth 30% less while executing perfectly. That is what priced for perfection means. No scandal required, no failure necessary, just a market that quietly stops paying for promises. It's 9:30 in the morning on June 12th, 2026, and in Times Square, the bell rings. Somewhere, an early SpaceX investor watches the ticker and becomes rich. By one estimate, one of 4,000 new millionaires minted today. For them, this morning is a finish line. For everyone placing a buy order, it is the start. Both groups are staring at the same number on the same screen. Only one of them is right. The market will decide which. It always does. The only thing history asks of you is this. Before you walk through a wide open door, notice which direction the people who built it are walking.